Also, of course, related as we watch all these numbers on this Cyber Monday, Amazon, the new king of the parcel delivery giants, knocking UPS and FedEx out of the running. That's according to company documents seen by the Wall Street Journal. The e-commerce giant had already delivered 4.8 billion packages by Thanksgiving this year and projects it'll do another billion by year end. Here with more on this is Scott Devitt, Equity Research Managing Director at Wedbush. Scott, it's great to see you. I hope you had a great holiday and that you're doing a lot of buying right now. You know, I'm so curious about this sort of battle, if you will, for package volume. It's something that UPS and FedEx seem to have stepped back on, at least the volume race. Is winning in this case? In other words, is it better for Amazon to be doing all this volume itself?
Well, happy holidays. And it's always easy for a competitor that's losing to say that they're not going after market share. So that's somewhat comical. But what's happened over the past many years has been that Amazon's taken share of delivery because it's providing packages delivered from itself and also the very large network of merchants that are on its marketplace. And so where Amazon's taking significant shares, they're taking volume away from UPS and FedEx that would have been delivered by either of those companies under scenarios at which those merchants actually weren't selling on the Amazon marketplace. And the way that Amazon's been able to do that is because they've increased their own last mile delivery. So they have a full logistics capability within the business. So the way that the market share has changed is that more merchandise that's retail oriented that's coming out of Amazon fulfillment centers is making up in the incremental market share gains that Amazon's getting from the other two providers. And Amazon's not in the business of picking up packages and delivering, which I think is market share that's probably safe for UPS and FedEx. But as it relates to retail, Amazon's built a better mousetrap.
And Scott, for Amazon investors who are listening to this right now, why should they care, Scott? Why should they pay attention to this headline?
Well, what's part of the moat of Amazon is the logistics capability that the company has. It's differentiated relative to other retailers, and it's part of what allows the company to gain and grow market share. And so the relevance of it is it's incredibly expensive to build the network that Amazon has, but now that it's in place, it's unmatched, unparalleled, and unable to be replaced by any competition. So the benefit that Amazon has is the experience they provide to the customer, which is why consumers go to Amazon.com. And because of that, that brings third-party merchants onto the marketplace, and Amazon can deliver products faster than any other provider, which is exactly what a consumer prefers on the internet. And one other data point that I provide is now, as Amazon has increased the regional aspects of its business in the United States post-pandemic, now in the largest 60 metro markets, over 50% of the packages are being delivered same day or next day, which is going to further the advantage this holiday season, with the holiday being on a Monday, and in general as well, taking share of consumer products categories that are more near-term in nature in terms of the consumer's preference to pick them up at a Walgreens or et cetera.
It's so interesting to me. Also, that's interesting. That market share number is pretty incredible. But because of Amazon's relationship with its customers, it also has more levers, you could argue. For example, I'm not communicating with UPS and choosing if I want to get my packages in a fewer boxes on a given day, right? Like Amazon gives customers that kind of flexibility and has that kind of dialogue, if you will, with customers. So is that data and is that flexibility also something that Amazon can use to its advantage?
Well, I think the advantage is in having the most trusted marketplace if we're using the U.S. example, in the country, for getting purchases delivered directly to the consumer's door. And that opens up all kinds of opportunities. It draws merchants into the marketplace because that's where the volume is. And when you have this logistics network bolted in with, as you mentioned, the example that you gave, you can also defer your shipment and get credits from Amazon Video and other things on Amazon as well. There's all kinds of things that would never be able to be done by a third-party provider that Amazon's now integrated into its system. So there's no going back, and there's no really reversing this advantage that Amazon's gotten. And that's why it's such a powerful player in retail right now. I would even compare that or contrast it to, Walmart, which has the capabilities to get products to the consumer very quickly, but they're not they're not in the mind of the consumer as it relates to direct distribution as much as Amazon. And two, I don't think they're as flexible or as innovative in terms of the initiatives that they have in place, which is why Amazon continues to take online share outside of grocery as well.
And Scott, more broadly, you look at Amazon here, it's up nearly 80% this year. Scott, you've got the equivalent of a buy on the name. What are the potential catalysts ahead for Amazon?
It's still not an expensive stock. So the catalyst ahead is significant margin expansion, which has only just begun. The company built out excess capacity due to the pandemic. So it wasn't excess during the peak of the pandemic, but as the pandemic ended, it became excess. It wasn't the fault of the company. It was just the nature we were going through a once in a generation experience, and it had to adapt to that. Now the company is building back into those fulfillment centers. So capacity utilization is improving and margins are beginning to rise. And it's probably the beginning of a 2-year cycle of significant increases in margin expansion. When we look out a few years, you look 4 years forward, this company is going to be doing north of 100 billion in free cash flow, and the following year, 120 billion in free cash flow. So when you start thinking about multiples, it's a very inexpensive stock if the company can execute on that margin expansion, which we're confident it will be. I think in the next 3 to 4 years, this stock is a $250 stock.
Scott Devitt, great to see you as always. Thanks for your time today.
Thanks so much.